would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to a Friday edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. Excuse me, but please don't hold that against me. I'm surviving on Dayquil and determination today, folks. Apologies for the slightly scratchy voice. Glad to see you've all made it to the end of the week. Congratulations. Hope all of your goals are getting reached. Or maybe you're already done and you're relaxing and ready for a weekend of kicking back a little bit. We are right on the doorstep of April. I hope you're ready to take on a brand new month. As we have done with most of the recent months, we will be doing another drawing for that Amazon gift card. Nothing like getting a $50 Amazon gift card just for being you. The best way to get yourself on that list of folks who will be in the drawing for that $50 gift card is to head on over to therebelbroker.com. Click on the big red button at the top of the page titled Take the Survey to Support the Show, and you'll be doing two things. One, you'll be helping to support the show. Two, you'll be putting yourself on that list for that $50 Amazon gift card that we're going to give out probably in the first 2 weeks of April. I'll give you plenty of warning so that you should know when it needs to be done by. Odds are it'll be 1 week from today. It'll be Friday next week by 5 p.m. And then right after 5 p.m. next Friday, I will actually pick a winner and try to reach out to them. Other information for you today. If you would like to provide any ideas, suggestions, observations, feedback of any kind, head over to therebelbroker.com, click contacts in the menu bar, and you'll find a page where you can do exactly that. And you can also join the Rebel Underground. There are now two ways to join the Rebel Underground. One is to text the word Rebel Broker to the number 44222, and then follow the prompts once you've done that, and you'll be in. The second way is to click the Join the Rebel Underground button that is at the bottom of the show notes for each and every show at therebelbroker.com. So feel free to do that, and you'll be all set to go. All right, so for today, the big payoff, well, I don't know if it'll be the big payoff, but the big news item, the headline news item, is actually one of my favorite stories that comes out on a pretty regular basis. And for those of you who've been listening for a while, you know that I like to cover a report that comes out. I'm not sure if it's quarterly or every other month, but it talks about the 25 markets with the highest returns for single-family homes. And the reason why I like it is because it basically says if you bought a home in this market a year ago, so you bought it recently, right? You're not holding it. It's not something that you're making profit on over this long period of time. It is a market where if you had purchased a property, a 3-bedroom, 2-bath home, single-family residential home in these markets, this is the return on that investment, right? And it assumes just pretty standard purchase practices. So it's a great way to calibrate, I think, because it's not based on some crazy thing you missed out on, right? Buying years ago. So I like that. It's a cool way to go. There are a couple of communities that were on that list last time that are on it again this time. I'm not going to go over the whole list of 25. What I might do is just zip right through a whole bunch and then maybe focus a little bit more on the top 3, and we'll see. I've got some other little news items as well relating to consumer confidence, a news item from Freddie Mac that I think is a little bit disconnected from reality, and some interesting news relating to debt in general. Again, another area that is worth being worried about, something we've talked about before, but this is sort of an update from that. So we'll cover all that information in today's show. To start off, I think we'll go ahead and jump in and go with the big ticket item first, that headline of what areas have given us the highest returns over the last year for single-family homes. Now, what's interesting about this is there was a bit of shifting in terms of where some of the best gains were seen when compared to previous quarters that this report's been generated. Quote, there was a notable departure from the past several quarters' trend of Sunbelt strength. The third quarter rent range data identified emerging rental rate increases among the Rust Belt in areas like Pittsburgh, St. Louis, and a trio of Ohio markets, Cleveland, Cincinnati, and Canton. Interesting, Florida and California, whose markets have long dominated the ranking of highest increases, saw their top 25 list representation reduced by half in the third quarter of 2016 compared to the third quarter of 2015. So that's something else we've been talking about, right? Where you max out in these markets that are often referred to as the sexiest markets, you find yourself topping out. And that's resulted in advice we've given here in that you'd be better off taking money. If you've got one property worth $1 million in California, you'd be better off going to some of these smaller markets and buying 3 or 4 properties for the same amount of money, and then as a percentage make more. So that's the kind of math you need to keep, I think, in mind when you're looking for your next investment, and when you're doing the smart thing that you should be doing every year and evaluating your current set of investments to determine whether or not they're doing the most work for you. Let's see. The one trend that they say is common here is that the single-family rental rate growth is already expensive, is in already expensive areas with robust expanding economies and tight inventory. Seattle, San Francisco, and Portland all moved up on the list despite discussion of rents and real estate markets having plateaued. Average gross yield, which dominates the income return from an investment prior to operating costs, the 5 top performers are all in the Rust Belt. So let's go ahead and jump through here real quick. I will also Pinterest this. So this list is kind of cool. So if you just want to see the list, you don't want to worry about checking out the article in question, you can simply do that. So the trends we were talking about before in this article related to the third quarter of 2016. This is now the fourth quarter number. So these are numbers that wrap up the year for us for 2016. I'm going to go ahead and start at number 25 and work my way down real quick here. I don't want to start wasting too much time until we get to those top performers. But I want you to be able to get an idea of where these things are spread out, because what I find super interesting about this list of the top 25, I am not seeing a single California community in here. Texas is making some appearances, but not in the top 5. So, and neither is Florida. So some of the areas that on our last list were being, or not, maybe the last list is the wrong place. Last quarter, we weren't seeing a lot of California for the same reasons we talked about a minute ago, but 3 quarters ago, or 4 quarters ago, it was a little bit different, right? So, and I think it's good to keep in mind the ebb and flow of who goes into and out of this list, because that helps you sort of figure out where plateaus are, right? If you start to see gross yield, particularly when you're considering just what it's made over the last year since the acquisition of the property, I think that really kind of helps to spell out how attractive it might be for you as an investor, to figure out where it is in the cycle. Is it at the top of the cycle and it's going to be declining? Or is it just starting to grow? All right. So to run through this a little bit more quickly here, at number 25, Columbus, Ohio, with 10.1% average gross yield in the fourth quarter. Number 24, Omaha, Council Bluffs, Nebraska, Iowa, 10.2%. Number 23, Philadelphia, Camden, Wilmington, Pennsylvania. I believe that one was higher on the list last time. 10.3%. Number 22, Greensboro, High Point, North Carolina, 10.4%. Number 21, Chicago, Naperville, Joliet, Illinois, Indiana, Wisconsin, 10.5. So there's Chicago again. This is the third time we've talked about Chicago. Chicago being picked out as one of the top communities to invest in, also as one of the most left places, and now again on this list in terms of gross yield. So it might be an interesting dynamic in Chicago. The reason why I'm kind of calling out Chicago is, given what we're seeing in terms of the numbers of people that are leaving Chicago since there isn't growth, it may spell an opportunity for you to get better deals on the properties themselves if you anticipate the trend will be to not see quite so many people leaving the area. And again, it's going to be about ground truth. I know I keep repeating that, but in a challenging area like Chicago, you need to make the right call, and that's going to be knowing the truth of where the more stable areas are within that community. Number 20, Pittsburgh, Pennsylvania at 10.6%. Number 19, St. Louis, Missouri, Illinois at 10.6. Number 18, Cincinnati, Middletown, Ohio, Kentucky, Indiana, 10.6%. Number 17, McAllen, Edinburgh, Mission, Texas. And that's our first Texas community. And there's quite a few Texas communities to come on this list. Interestingly enough, I don't think any of those communities were on this list last time. That came in at 10.6. Number 16 was on the list last time. Dallas, Fort Worth, Arlington, Texas at 10.7. Number 15, Kansas City, Missouri, Kansas, 10.9. Number 14, Wichita, Kansas, 10.9. Oklahoma City, Oklahoma, 11.2. Houston, Sugarland, Baytown, Texas, 11.2%. Number 11, Columbia, South Carolina, 11.2. Number 10, Tulsa, Oklahoma, 11.7. Canton, Massillon, Ohio. I hope I pronounced that correctly. Sorry if I didn't. 11.7%. Number 8, Indianapolis, Carmel, Indiana, 11.8. Number 7, Birmingham, Hoover, Alabama, 12.1%. Number 6, Milwaukee, Waukesha, West Allis, Wisconsin, 12.5. Number 5, Toledo, Ohio at 12.5. Number 4, another one that has appeared on our list over and over, not just this list, but tons of other lists. Memphis, Tennessee, 12.8%. Just the sheer repetition of that town makes me want to take a closer look at it. Number 3, Dayton, Ohio is at 13.1%. Number 2, Detroit, Warren, Livonia, Michigan, 13.5. So there's Detroit again, which remember when we looked at our list the other day was number 2 in terms of the number of people leaving. Granted, it was far lower than Chicago. I believe Detroit was 17,000 folks net loss in terms of migration, whereas Chicago was 66,000. Same percentage, though, of population in terms of the larger community. Number 1. The number 1 community, Cleveland, Elyria, Mentor, Ohio, 13.7% gross yield in the fourth quarter. And if I'm not mistaken, Cleveland has appeared on this list in the top 10 over a couple of the last quarters. So looking for the more, there's 2 ways to look at this list. You can go back and check it out. Now, at the link I'm going to provide to this story, you'll be able to check the previous reports. So if you can look for ones that have been consistently over time in the top 25, which indicates a level of reliability. You can look for ones that appeared and then stayed for a while, because you might want, and you can look at ones that peaked and then dropped. So that can kind of give you an idea, calibrate you to the direction the market is moving in that particular community. Is it one that is just starting to get going and you potentially have more upside to take advantage of, or at this point, is it in decline or flattening enough that it's not worth your time to really consider that as your next place to go? Now, of course, this is data that's not just good for people that are shopping for their next investment. This is also great for folks to do that year in review on their current holdings. If you own an investment property, I think it is a great idea to figure out where you sit in these types of calculations, because you can look back historically at the data and decide, you know what, while my investment seems to be making me an okay amount of money, what if I got rid of it and moved to one of these other locations? You could absolutely be getting far more bang for the buck potentially, depending on where that current investment you have is held. So look at this as a way for you to use some data to analyze how well your current investment is working for you. If you're only getting 6 or 7%, well, maybe your money would be better invested in some other real estate holdings. So just something to think about, and a great thing to do at least on a yearly basis when it comes to reviewing your properties. All right, so we're going to take a quick break right now, but when we come back, we're going to have our chat about Freddie Mac and the consumer confidence numbers and those other wonderful things. So don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com. www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We're going to jump in and get a few more pieces of data that plug in nicely with things we've been talking about over the last few weeks. One is consumer confidence. It seems like with each consumer confidence report we get, we are breaking a new record, right? I can remember it wasn't long ago we were talking about consumer confidence being at a 7-year high, and then it was an 8-year high, and then it was a 10-year high. Well, with the most recent numbers that I'm seeing from yesterday, consumer confidence has surged to a 16-year high in terms of the short-term business outlook. The consumer confidence index improved significantly in March to 125.6 from 116.1 in February. A great deal of those improvements were relating to business and labor market conditions. So those are good things because as folks have confidence in that helps them have confidence in their employment situation moving forward, which is good news. And we talked about it yesterday being a little bit of a double-edged sword based on just some of the other debt information we've been able to look at. Again, we'll see another indication how that is a little bit scary coming up. But in general, having confidence in what the path holds for them is a good thing. In just about all the areas that would affect that, we're seeing positive numbers. Business conditions are good, increase from 28.3 to 32.2. Let's see. Percentage of consumers saying jobs are plentiful, increased from 26.9 to 31.7. More optimistic about the short-term outlook, saying business conditions will improve over the next 6 months. Increased from 23.9 to 27.1. And remember, when we were talking about some of these reports before, these were changes of 1%, 2%. 3% if we were lucky. These are some substantially big jumps. In terms of the labor market, this is where some of the biggest jumps were registered. It's at let's see, expecting more jobs in the months ahead, increased from 20.9 to 24.8. And the number of folks expecting fewer jobs decreased by over 1%. Expecting their incomes to go up, jumped from 19.2 to 21.5. So in general, we're just seeing a lot of swings towards a confidence that you would think would move people into making decisions relating to finances that would be beneficial for the real estate market specifically. Again, I'm still waiting for those numbers to come out with specific references to real estate, but I thought this was something interesting to share because the other data we have didn't give these kind of detailed numbers. Something else that I'm going to file under stupid is a article that's coming to us from Housing Wire. Freddie Mac, their statement is affordability to hold back home sales in 2017. That's not the problem. The problem is inventory. We keep saying it. I wish they would keep saying it, but of course, their interest is in money moving around, so they're more interested really in the loan side of things. Home prices continue to rise, increasing 76% from 2000 to 2016, while capita income increased 72% during the same period. And what's nuts is they go through here and then continue to raise the "we need to lend more money" flag. Now, what's interesting about the article I'm sharing with you in today's show from Housing Wire, which again you can find at the website at therebelbroker.com, in a link to it in the show notes. While there is casual mention of the tight inventory, when you look at what Freddie Mac is doing, it's all about facilitating more loans. It's not about addressing the inventory side of it. So I would really love someone out there who has more sway than I do to start singing that one, because it's just annoying to hear this same sort of refrain get put out there. All right, next on our hit list of interesting stories, this one comes to us from Zero Hedge, signs of an auto bubble. Now, we've talked about all the bubbles that are floating around out there, right? The potential bubbles. We're in the process of what seems like reinflating a bubble relating to mortgages. We've already inflated a bubble relating to student loans in excess of what the last real estate downturn was, coming up to 1.31 trillion, where 1.3 trillion was what we saw with the housing crisis last time. Now we're seeing soaring delinquencies in these 266 subprime ABS deals. Let's see. To quote the article, if you're among the growing minority of investors still under the impression that everything is awesome in the auto industry simply because new car sales volumes continue to hover around all-time highs, while turning a blind eye to soaring incentive spending and the pesky little debt bubble, then we may need your help with how we should be interpreting the following subprime auto loan delinquency stats from Morgan Stanley. First, despite low employment, high consumer confidence, and debt-to-income ratios at 30-year lows, 60-plus day delinquencies and default rates are soaring back to Great Recession levels for prime and subprime auto securitizations, meaning just the loans that are out there. Now, this is a concern. To be greater than 60 days delinquent is considered a kind of line that you really don't want to cross. Let's see. It also has a flood of lease returns that are about to hit the market. There was a big bubble on leases, for example. Now, one thing that comes out of this article that I picked out because it was important, at least I thought it was, quote, the securitization market has become more heavily weighted towards issuers that we would consider deep subprime, those with a weighted average FICO score below 550. And according to this, since 2010, the share of subprime auto ABS origination that has come from these deep subprime deals has increased from 5.1% to 32.5%. So again, we're talking about a system of putting out money that creates debts on people's shoulders that is aimed at people with the least number of resources to tend to their debt in terms of experience or in terms of financial maturity or in terms of even demonstrated history of being able to live up to the requirements of their debt. Does that sound at all familiar? We're doing that same sort of reaching when it comes to mortgages. And then the student loan environment. Those loans are exceptionally easy to get and unfortunately rack up. And we've already talked about how delinquency rates among those is up, and the fact that most of the folks who have those, well, not most, 50% of them, half of them, tend to assume they're never going to be asked to actually repay that. The truth is that will have to get repaid, and I'm not sure how folks come to the conclusion that that's just something they'll never have to pay back. But again, remember, that's $1.31 trillion. So that's a potentially earth-shattering amount of money. When you blend it with all these other things relating to the automobile industry, it becomes even more worrisome. Because remember, we've talked about the overall debt profile. How much debt are people carrying? It only takes a bad situation to cause people to react to their debt in the same way they reacted last time. We had some people who abandoned it. We had some people who tried to game the system in terms of getting into debt on something else and then abandoning the debt. All of this could kick off the exact same sort of domino effect that we've seen in the past and end up pushing us right down into the sort of financial trouble that we experienced with the last downturn. It's really going to be interesting to see how these things cross each other's paths. With all of these various places where immense amounts of debt are growing, it's one of those things where as you watch it, it's like watching your child trying to reach that top shelf in the kitchen, and they're balancing on top of two chairs and a dog and a ball and hoping that they don't fall and kill themselves. It's kind of ridiculous. We'll see how these things play out. But there are so many potential failure points here. It's concerning. All right, folks, I am getting beaten down by whatever it is I've contracted from my children. I'm going to go ahead and call it for today. I hope that we have managed to give you at least as much value in terms of the information we've shared today as you have spent in terms of time listening to the show. I truly appreciate all of you who've been out there to help the show grow, who have clicked that big red button at the top of the page titled Take the Survey to support the show. You have no idea how much I appreciate it. But I do, and I want to thank you for that. I'm continuing to see growth in the show that only happens because of what you folks do for me in terms of sharing the show with other people and saying great things about it. And I actually got another email from someone today pointing out that there was another website that put the show on the top 10 real estate podcast that people should listen to. And that only happens because you folks make it popular. So thanks again from the bottom of my heart. I appreciate it. Thanks for listening. Excuse me. Have a fantastic weekend, and I'll talk to you all next time.